Welcome to today's Explainer. We are diving straight into how absolute mathematical certainty, combined with new U.S. legislation, is fundamentally restructuring the $300 trillion global credit market. We're talking about a massive paradigm shift for balance sheets everywhere, driven by this crazy intersection of high-level physics and bipartisan policy.
Imagine walking onto a high-tech trading floor right now, but instead of those familiar green and red stock tickers, the monitors are glowing with orange sat velocity streams. You gotta ask yourself, what actually disrupts a $300 trillion credit market? What happens when a non-sovereign digital asset literally becomes a Tier 1 strategic reserve? Well, the answer comes down to replacing human subjectivity with hardcore mathematical protocol.
To wrap our heads around this shift, we need to define what digital credit actually means in this new architecture. We're talking about taking a traditionally volatile asset, completely stripping away that volatility, and distilling out pure, low-risk yield. By using Bitcoin as pristine capital, institutions are structuring what industry leaders are calling an anti-fragile digital credit layer. Here is our roadmap for today. We'll hit the sovereign yield curve, ARMA, which is basically Bitcoin's institutional IPO, funding via gold revaluation, the physics of autopoiesis, the power law decoupling, and finally, collateral for the next century. All right, Section 1, the sovereign yield curve and the legislative road to a new reserve. The momentum in Washington has shifted incredibly fast. It's actually wild to watch. We went from the early frameworks of the Bitcoin Act back in July 2024 to a sweeping presidential executive order in March 2025, right into the bipartisan American Reserve Modernization Act, or ARMA, introduced in May 2026. We're literally watching policy evolve from executive decrees, which, let's be honest, can be overturned pretty easily, into codified permanent statutory law. Section 2. ARMA, Bitcoin's institutional IPO. This is where the framework gets very real for institutional investors. The legislation authorizes the U.S. Treasury to acquire up to 200,000 coins a year for 5 years. The ultimate target here? 1 million Bitcoin. That is roughly 5% of the total hard-capped global supply, placed permanently onto the national balance sheet. But the absolute crucial variable here is 20. The ARMA bill mandates a strict 20-year lockup on all federally held Bitcoin. By structurally ripping that massive chunk of supply out of circulation, it protects the reserve from short-term political wins. It basically forces a foundational floor of demand. Moving on to Section 3, funding via gold revaluation. Now, I know what you're thinking. A massive purchase program sounds incredibly expensive, right? So how does the government fund this entirely budget-neutral accumulation without touching a single taxpayer dollar? It's through a fascinating accounting loophole. The Federal Reserve actually holds gold certificates on its books at a statutory price of $42.22 per ounce. Yep, a price literally stuck in 1973. By correcting this 50-year-old accounting fiction to current market prices hovering around $4,500 an ounce on over 8,000 metric tons of gold, the Treasury magically unlocks over $1 trillion in paper gains. Gains they can deploy directly toward digital era value. Section 4. The physics of autopoiesis. Why target this specific asset to back the future of credit? It's a big word, but a fascinating concept. Autopoiesis means self-creation and self-production. In biology, think of how a single cell maintains and reproduces its own internal structure. Astrophysicists and researchers point out that Bitcoin is entirely unique among financial assets because it acts exactly like this biological system. It manages its own creation, production, and security via math, totally independent of external issuers or corporate boards. Just look at the contrast here. On one side, we have the decaying legacy system, driven by subjective human loan committees, shifting monetary policy, and exponential debt. On the other side, the new paradigm. A fixed protocol, absolute mathematical certainty, and self-organizing autopoiesis. It doesn't rely on trust, it relies strictly on verification. Section 5. The power law decoupling. Let's look at how this autopoietic nature builds into something so much larger. I absolutely love this quote from physicist Giovanni Santatasi. He says, "We are turning corporations into cities. Cities are eternal." Think about it. The average S&P 500 company today lasts less than 20 years before it's acquired or just goes obsolete. But cities? Cities last for millennia. Because Bitcoin grows bottom up as a decentralized network, its growth mathematically mirrors the resilient scaling structure of those eternal cities, completely decoupling it from the fragile life cycle of a tech corporation.
When you run the Monte Carlo probability paths, you see that Bitcoin's trajectory is not some unstable exponential bubble destined to pop. Instead, it mathematically scales with time, following what physicists call a power law. It's decoupling from speculative tech equities because it's a network establishing itself as a foundational monetary layer. Over time, those massive volatility bubbles shrink, and the asset stabilizes along a highly predictable, long-term mathematical trajectory.
And we are already seeing sovereign game theory play out globally. The US currently holds roughly 328,000 seized coins, worth over $25 billion. If ARMA codifies this into a reserve, it sparks an immediate reflexive race. Look at China, with an estimated 190,000 coins, and the UK with 61,000. When the largest economy in the world recognizes an asset as a Tier 1 strategic reserve, other nations simply cannot afford to sit idly by.
Which brings us to Section 6, Collateral for the Next Century. Let's tie this all together and figure out the ultimate bottom line for your balance sheets.
By codifying this reserve, ARMA signals to every pension, every insurance fund, and every bank that the institutional haircut risk is gone. It elevates Bitcoin to a Tier 1 reserve asset right alongside gold. This is the exact catalyst needed to enable those highly distilled digital credit products we talked about earlier. We're talking instruments capable of paying daily dividends, offering 0% volatility, and delivering structured yield. It essentially transforms forward-thinking corporate treasuries into modern-day reserve asset banks, issuing pristine credit against absolute mathematical scarcity. I want to leave you with this final provocative thought to chew on as you review your own institutional risk models for the century ahead. If the US government is actively moving to correct a 50-year-old gold accounting fiction just to structurally lock up digital capital for the next 20 years, what is the risk of leaving it off your balance sheet? Thank you so much for joining me on today's Explainer, and I'll catch you on the next one.